In this video, I'm going to talk about stocks versus the election, and we're going to go through 5 charts and what happens if President Trump gets reelected and what happens if Biden gets elected. But before we do, if this is your first time at our channel or you haven't subscribed, click on the subscribe button at the bottom. My name is Travis Sickle, certified financial planner, helping you reach your financial goals. So before I pull up the first chart, a little disclosure. All this information is historical data and not necessarily an indicator of future performance. You need to make your own trading decisions. I'm not telling you whether or not to buy or sell, stay in the market, or get out of the market. So now that disclosure is out of the way, let's go ahead and talk about the first chart. Now the first chart is going to show the last 7 elections and what happened after the first year. So this is from 1993 all the way up till 2017. And you can see that each one of these years is the year after the election. So up here we have the White House, so that's the president and who was in office. So it was a Democratic president or a Republican. And then we have the Senate and then the House of Representatives. Now the first line here is the S&P 500 index and the performance in that year. And then we have the different sectors right below it. And when we're looking at this information, we're trying to find something that we can take back to our investment portfolios and tweak them to get a little bit better rate of return or make a more informed decision of whether or not we should stay in the market or get out of the market. So here's a couple of takeaways that you can look at with this chart. The first one is that it's overwhelmingly positive. So of all of these different rates of return, the different sectors, the S&P 500, there are 81 rates of return here. And of those 81 rates of return, 81.5% of them are positive. So it's overwhelmingly positive in the year after the election with the last 7 elections. And the only sector that is positive every single year is the material sector. So you can see every single one of these 7 years, it has a positive rate of return. But that's not nearly as interesting as if we add up the rates of return of the S&P 500 and divide by 7. So what's the average rate of return over these 7 years? It's 16.73%. Now, if I pull up this other chart really quickly, these are all the rates of return of the S&P 500 since 1926. And if we zoom in here to see what the rate of return or the average annual rate of return was since 1926 up until 2018 on this chart was 10%. And we can see that right down here. So 1926 till 2018 was an average annual rate of return compounding at 10%. And from 1926 to 2017, it was 10.2%. So if we go back to this chart and if we added up these 7 years of rates of return, that average is 16.73%. But if we break that up between Democrats and Republicans, for the Democrats, that works out to 25.57%, where the Republicans was only at 4.95%. Now, does that tell you that you should only invest your money if Biden gets elected? Not necessarily, because if we looked at 2017, that got a 21.83% rate of return. So if you had taken that same logic, then you would have missed out on a year that got more than double what the average rate of return was since 1926. Now, if we dig a little deeper into this top part where it says the White House versus Senate versus the House of Representatives, let's take a little bit closer look at what it looks like for the S&P 500 versus the presidency and Congress. Now, I've shown this chart before, and you can see from the Democratic presidency that the rates of return are higher than if a Republican president was in office. Now, what's really interesting about this chart is the fact that in both scenarios, both when a Democrat was a president and a Republican president, the split was better than when Congress was also a Democrat or a Republican. So you can see here, Democratic president and a Democratic Congress had a 14.3%, but when it was split, it was higher at 16%. The same thing is true for the Republican presidency, where it's 10.7%, but when Congress was split, then it was 17.6%. So this is historical data that goes up to 2019, but in 2020, the market's at an all-time high, and what do you know? We have a split Congress. So while they're arguing over the next stimulus package, which isn't really great for the economy, as far as the stock market goes, it's at an all-time high. And this is exactly what this chart is showing us. And if we go to our next chart, and we look at the S&P 500 index and the US presidential election years, what we're looking at here is each election year. So in 2016, Trump became president, and we had a 12% rate of return. But here we have a little bit different story. A Republican was elected, the average rate of return was 15.3%, but when a Democrat was elected, it was 7.6%, but the average was 11.28%. But there are two important points that we can pull from this information, and the two are very relevant for our upcoming election. So the first one is, what was the rate of return if a Republican president was in office and then a Republican was either reelected or a Republican was put into office? In our situation that we're seeing right now, what happens if President Trump gets reelected? Well, the average rate of return if a Republican was in office and gets reelected or a Republican gets elected, that rate of return was an average of 11.9%. Now, on the other side, if we had a Republican in office, which is what we have now, and then a Democrat gets elected into office, that's an average rate of return of negative 2.6%. So here's the question. And let me know in the comments down below what you think. Is the market a predictor of the presidency, or is the presidency a predictor of the market? In either case, we know that the presidency isn't the only thing that's going to affect the market. So let's take a look at two other charts for the best days and the worst days in the market. So this chart is showing us the best days in the market and what happens after that. And that's really important for us to look at, considering that the market has done so well in the last several months. So if we look at some of the best days in the market, what happens after that? If we're looking up here at October 13th of 2008, a great day in the market at 11.58%. A year later, it was still positive. 3 years later, it was still positive. And even 10 years later, it was still positive at 10.68%. If we look at all the dates here, all these are positive single day returns, the average being 6.79%. What we can see here is that across the board on these averages, the market return was still positive 1, 3, 5, and 10 years later. It was only a few times on the 3-year and the 1 year for 2008 that it was negative a year later and 3 years later. And we can see that right here and right here. And I don't see any other, there's another negative number right here. So we have down 0.7 of 1%, and that was in 1997. And that was after 5 years. But overwhelmingly, the market continued to press forward. So that's a big deal when you're thinking of buying low and selling high. The market's at an all-time high, but looking at this information might tell you otherwise of whether or not you should buy or sell. Of course, you have to make that decision on your own, and I'm not telling you whether or not you should buy or sell, but it's interesting after a market had a high that it still pressed forward with positive returns. Now, if we look at negative rates of return on the worst days in the stock market, even the 1, 3, 5, and 10 years, so the same information, it's still positive. So even with the worst day in the stock market in 1987 down 20.47%, 10 years later, it was up 15.43%. And the averages for the negative rates of return, where there was an average of down 8.13% or negative 8.13%. 1 year later, the average return was 22.38%. Then on the 3, 5, and 10 years, all positive rates of return. So whether or not you had a positive day or a negative day, when we're looking into the future, or historically speaking, the market was positive. Now, here's the thing about averages that you really need to pay attention to. They can be a little bit misleading. The reason being is I showed you an average rate of return of 10% from 1926 to 2018. But if you took that information expecting to get a 10% rate of return each and every single year, you're going to be really disappointed and possibly make a poor investment decision. So it's really important that you're understanding that the average is over a very long period of time, and any one particular year can have really high highs and really low lows. So make sure that you go back to the basics and look at what those averages are, not to make a poor investment decision in the short term. And I'm sure moving forward, as we get closer to the election, we'll hear more and more on how you should be in or out of the market based on a presidential candidate. And the two takeaways from all of these charts and the information we just went over is that specific events aren't necessarily good predictors of market performance or future market performance. And historically speaking, over time, markets go up. So I hope this has helped you make a better and more informed decision about your portfolio and the stocks that you own in stocks versus the election. If you've enjoyed this video, be sure to subscribe and leave your comments down at the bottom.